Did the gold price rise from 2,000 to 4,000? Or did it fall from 4,200 to 4,000? In other words, did we get a $2,000 price increase or a $200 price decrease? And I think that matters. I think in the next 10 years, that the nominal price of gold, measured in US dollars, increases substantially, perhaps threefold. What that means is that the blip that we've seen in the last 3 weeks is just that, a blip. And I think that you need to put that in context. I think this market has a long way to go, but that long way is going to be punctuated by blips like this and more severe often. And if your audience isn't financially and psychologically prepared for those blips, they're going to get shaken out for no reason whatsoever. I remember a blip called 1975, where the gold price declined by 50% over 9 months without derailing the gold bull market. So understand that this will not be stair steps to heaven. As to my selling, it had nothing to do with market timing. It had nothing to do with trading. It had to do with the fact that I thought that the junior mining shares had gone too far too fast. Specifically, I was able to sell 25% of my holdings in the sector and take out all of the money that I had invested in the sector since the year 2020. I was able, in arithmetic terms, to trade 25% of my upside in return for eliminating 100% of my at-risk downside. I was also able to shift the money, the proceeds, from a sector that I thought was, in the near term, fully valued, into places that I thought were more attractive. In particular, half the proceeds from those sales went into physical gold itself, a lower risk way to play the same game, and into the shares of 3 senior companies, Wheaton Precious, Franco-Nevada, and Agnico Eagle. In other words, I maintained the beta part of the trade and I gave up part of the alpha. The rest of the proceeds, the other 50%, went in the oil and gas business, which I see as being as roundly hated now as the gold trade was in 2022. So, there's a couple important lessons there. The first is that gold and the gold stocks have a long way to go, but they're going to be volatile and they're going to be cyclical. The second is that my selling had a lot to do with individual portfolio management, more to do with that, frankly, than it had to do with my perceptions of the market. But the third part is, as an investor and a speculator, I chase hate, not love. And the gold market, particularly the junior gold market, isn't hated anymore. Oil priced in gold, it wouldn't surprise me if oil priced in gold continued to decline. That doesn't matter much to the profit. Well, probably helps the profitability of oil companies, which is really what I'm interested in. The net present value of both. The chart that you showed is the chart of hate. That combined with the fact that burning oil generates carbon is responsible, I think, for the opportunity that's in front of us today. People are either bored of oil or afraid of oil, or they hate oil, all of which says there's more sellers than buyers. And bargain markets are a consequence of having more sellers than buyers. If, by contrast, you ran a chart of sustaining capital investments in the oil business relative to revenue in the oil business, what you would see is that sustaining capital relative to revenues is at a real low. And sustaining capital is the stuff of production maintenance or production decreases going forward. If you looked at another chart, which is free cash flow generated relative to historic norms, you would see that the industry is enjoying spectacular free cash flow. But rather than investing it traditionally, as the industry has done, in sustaining capital or new project investments, they are either in state-owned firms using it for politically expedient domestic spending programs, or in the private sector, particularly in Europe, returning it to shareholders by way of dividends or share buybacks. And this is really what my thesis is about. The International Energy Agency suggests that the oil industry globally, including state owned firms, is underinvesting in sustaining capital to the tune of about $2 billion a day.
Wow.
That underinvestment translates into a difficulty maintaining production at today's levels 3 years out and 4 years out, while demand continues to grow. That's the thesis. On top of that, of course, you have the fact that investors are either bored or afraid or feel hate towards the oil industry. The best, the easiest money to be made in speculation is buying hate and watching the sector go, perhaps not to loved, but merely to unhated.
Mm-hmm.
That's what we did in uranium. That's what we did in the junior golds. And I'm getting set to do it again in oil and gas. I'm sitting
You
out
mean
on a
hatred?
lithium trade at present. I had expected lithium hatred to occur in 2026 or 2027. I don't believe that we ever had a shortage of elemental lithium. We had demand peaks from lithium ion batteries that overwhelmed our ability to convert that raw lithium into lithium chemicals. Those processing bottlenecks are largely eliminated, and hence the lithium prices collapsed. The lithium boom in exploration yielded a lot of potential new supply. I would suspect that we either discovered or rediscovered 150 deposits worldwide. There are probably only 10 of those that are economically viable. In this pricing environment, that means that the shareholders of the other 140 have a lot more pain to come. What keeps me out of deploying to the 10 best projects, which is something I probably will do in 2026 or 2027, I say probably, is developments in direct lithium extraction. Technologies that may or may not work, but they're being pursued by little tiny companies like Berkshire Hathaway and Exxon,
Mm-hmm.
that would allow the recovery of lithium from saltwater brines, particularly those brines produced in conjunction with producing oil and gas. If direct lithium extraction works, which is to say that you can take a waste product called scale from the oil and gas industry and sell it as lithium, then it's going to be a very, very, very tough environment for the hard rock producers. And it's my waiting in particular for announcements from Exxon around production of direct lithium extraction experiments that are undergoing, that's keeping me out of the lithium market present. I don't know if it's going to work. I don't know if it's not going to work, but I want to get some sense of whether it's going to work before I dip my toe in the space. I'm not playing the whole game in rare earths because I don't believe that all rare earths deposits are created equally. And the ETF forces me to buy the good, the bad with the ugly.
Mm.
There are 3 or 4 rare earths deposits which I own, or I own, pardon me, the shares in the companies that own them. I'm looking for deposits that are potentially world class. I want 10 or 20 billion dollars worth of in situ recoverable reserves and resources at today's commodity prices. In other words, I want must own deposits. I want deposits that'll be in the lowest cost quartile worldwide and in the best quartile worldwide in terms of return on investment, but minimally 25%. What that means is that my field of choice is really, really, really constrained. I don't want to buy the sector so much as I want to buy the best undeveloped deposits in the world in the sector. I do believe that geopolitical tensions, not merely between China and the US, but between industrial supply chains, European, Japanese, Chinese, Americans, will mean that rare earths come to be viewed really, truly as strategic materials. And as a consequence of that, that the current US and Chinese actions to subsidize this business by the state will yield lower costs of capital for the nascent producers. And I definitely want to play that game, but I don't want to play that game across the waterfront. I want to select the best of the best. I took my junior bucket, and I define junior here loosely. That includes some junior producers who I've owned. And I looked at the entire investment that I have in that sector going back to the year 2000, not my legacy positions, not the ones I had tucked away in a safe deposit box, but my investments in the period 2020 to 2025. And I sold 25% of that bucket, not all my gold stocks. And importantly, I redeployed half of the money from those sales back into lower risk gold investments.
I see.
In other words, with part of the proceeds, I bought physical gold. With some of the rest of the proceeds, I bought Franco, Wheaton, and Agnico Eagle. I decided deliberately to reduce my potential profitability in return for eliminating all of my risk.